Hi everyone, Donna here with Bookkeeping Made Simple, and today I want to talk about some topics that I very seldom see addressed on financial websites or blogs or YouTube channels or anything, and that is depository insurance, FDIC and NCUA. I am not making this video, by the way, because I think the banks are going to collapse. I really think that's the furthest thing that's going to happen, but from time to time, it happens. We just recently saw this with Silicon Valley Bank. And it does happen once in a while. And I think First Republic just got bought out. And there's been some mergers over in Switzerland with Credit Suisse and UBS. So I think it's an important topic to cover. Again, I am not doing this to scare anyone or create a panic. I am very confident in my bank. I bank with Chase. I'm very confident in them. And then for our other business, we bank at a local credit union. I'm very confident with them as well. So please don't take this as the banks are failing. I need to get my money out. That's ridiculous. This is just, I don't usually see people address what deposit insurance is, what it covers, and how you get your money afterwards. So I thought it would be a useful video to talk about. So in the United States, oh, of course, before I get into this, if you enjoy these videos, please like, share, and subscribe. Feel free to make comment of anything you'd like me to cover in future videos in the comments. That does help me determine what it is that you need to hear. I try to put out a lot of good content that's useful and timely so that you can make good decisions about your business or about your finance if you don't own a business. This is mostly directed towards business owners who are in the trenches. Business ownership is really hard, and most people do not have the resources of an Elon Musk or a Jeff Bezos or a Bill Gates, where they have armies and armies of attorneys and accountants to help them. Most people can barely afford to keep their nose above water. So those legal and accounting expenses can feel like they're way out of reach. So wanted to talk about FDIC, NCUA. Again, there's no particular reason for this. I just thought it was interesting that we don't talk about it. I don't know why. Maybe it's one of those things like when I was a kid growing up and at my age is showing, we were told not to talk about religion or politics and money. So maybe this is kind of a holdover, but we don't talk about deposit insurance. Most banks, most financial institutions in the United States are covered under one of two federal depository insurance programs. One is the FDIC, which is a federal program that insures deposits at banks up to $250,000 per depositor, not per account. I thought it was per account for years. Per depositor. So that means that if you have a business entity, it's treated as a separate person. I've talked about this. So if you have a business entity and you have an operations account and a payroll account and a tax account, and you're keeping your funds separate, only the entity is covered, not the individual accounts. Per depositor. And that really kind of threw me for a loop because I thought it was per account, but it is per depositor. So and you're covered up to $250,000. Now, if you're an individual and you're your average middle class person, you may not have $250,000 in the bank, so this may not apply to you. But if you're a business and you have a lot of money in the bank, a lot of businesses really do need to have several $1 million or at least a couple $1 million in the bank and only getting a small amount back, which 250,000 doesn't sound like it's a lot, or it sounds like it's a lot, but for a business, it's really not. So it's something you need to be aware of. Okay. Again, this is all on the idea of preparation. You know, if you know, you know, and if you are prepared, then you don't need to worry about things. You just need to be prepared. I come from a scouting family and an Army family. And one of the things we did actually always learn was that Of course, the Boy Scout motto and the Girl Scout motto has always been, be prepared. And when Robert Baden-Powell was asked, be prepared for what? He said, well, any old thing. So this is the spirit in which I'm making this video. Just be prepared, know what's going on. And because if ignorance is not bliss, ignorance, when it comes to preparing and making sure that you know what's going on with your money, ignorance is not bliss. You need to know what's going on with money, especially with your money. So let's talk about, first of all, what financial institutions are covered. And like I said, the FDIC is a federal organization. I believe the NCUA is the same, but I am not as sure about that one. They're basically the same in the way they function. So I'm only going to talk about FDIC. So if you bank at a credit union, understand that this is also covered by NCUA. And the coverages are the same, the methods are the same, just one covers banks and one covers credit unions. So let's start with what the difference is between a bank and a credit union. And that's actually something I've always wondered, okay? There's a bunch of things that we can talk about. So a bank, for one thing, a bank is for profit and credit unions are not. And as an accountant, my experience has been credit unions are for individuals and banks are for business. That has been my experience. We have more problems working with credit unions trying to serve our clients than we have working with banks. And I really feel like banks are designed, they're bigger. Credit unions are usually very small. Not that that's bad, but we have several here in Utah that, and I won't call them out by name, that do things like, yeah, they'll maybe give us guest access to the accounts, which we require, because we can't do accounting without having some sort of access to the accounts. We just have to. And usually what we ask our clients for is what's called view access. And that means we can go in, we can look at the accounts, we can download the transactions, we can pull up copies of checks or copies of deposit slips and see what's going on in the account. And yeah, I know deposit slips and checks are getting to be a little bit obsolete, but they are still used. So we need to be able to see them. If we see a check made out to Mary Smith, we have no idea. Or if we see a check and all we see is it's check number 1001, we don't know who it's made out to. We don't know who it's, what it's for, what services they were paid for. We need to be able to see a copy of the check. In the rare event that someone actually sends in a check for payment, we also would like to see the deposit slip so that we can see if, especially and it's a lot less common now, everybody now uses their cards, debit cards, credit cards. We are going more towards a cashless society. Whether you think that's a good idea or not, I guess we'll wait and see. I tend to have cash with me, at least some, just in case, because ATM terminals can go down, point of sale terminals can go down, but cash lives on. So, I think it's a good idea to have a mix personally. And people are going to do what's best for them, as long as the powers that be that, try to butt out. There's my politics. So first of all, understand credit unions are smaller. They are not as geared towards business as banks. We have credit unions here in Utah that grudgingly give us guest access, which we require, and don't even allow us to see the statements, which we require. And I'm just like, who told you that was a good idea? On the other hand, the big banks, I personally bank with Chase. So that means that I go onto their website. I can determine who sees my accounts, what level of access. I can set them up a username and password, and I can give them certain levels of access. And it's really, really simple with the big banks. Now, the little banks don't have those resources. And credit unions sometimes don't have those resources. Or more typically, credit unions are more geared towards a very specific population. when I was in college the first time, one of our credit unions here in Utah was called Campus Credit Union. It was UCCU, University Campus Credit Union. And I actually banked with them then. And I banked with them for many, many years, even after they became, they changed their name. It was still UCCU, but they changed their name and I don't remember what it stands for anymore. Utah Community Credit Union is what it is now, but it used to be University Campus Credit Union, and it was only for college students or faculty at specific universities. In my hometown of Paducah, Kentucky, there's a credit union that is specifically for employees of one of the uranium enrichment plant. There's another one that's specifically for Lockheed Martin employees. There's one that's specifically for federal government employees. So credit unions kind of limit their membership, and they do refer to it as a membership. It's not really a bank. It is owned by the people who have deposits in the credit unions. Banks, on the other hand, are typically for profit. So they usually charge higher interest rates. They charge higher overdraft fees. They charge higher monthly cheat fees. That is kind of the way it goes. And it is harder. It's much harder for me to get a loan through Chase than it is through my credit union. So I do typically do loans through my credit union and then bank with Chase. And I usually have a small account in the credit union just to make sure that I can make my payments on time. So that's the big difference. Banks are owned by, they're usually publicly traded. They're owned by they're run by a board of directors. They are for profit. Credit unions are owned by the people who have their money on deposit. You have to become a member of the credit union. You never hear about becoming a member of a bank, but you become a member of a credit union. And they have every single person that has a deposit account at a credit union has a right to say who's going to be on the board of directors. That's not the case with a bank. Okay. And like I said, it seems to me that banks are much more geared towards business, which means that as an accountant, I tend to work more with banks than I do credit unions. There's some pros to cons to each of these. I'm not going to go into this right now. This is about deposit insurance. In the United States, there's two different organizations that cover deposit insurance. One is for banks, FDIC, and the other one for credit unions is NCUA. I'm only going to talk about FDIC right now because that's the one I'm most familiar with, but they are basically the same. Okay, the coverage limits, what they cover, the amount that they cover is the same. Okay, so I feel pretty confident that if I talk about FDIC, I'm also talking about NCUA. So how it works is actually pretty simple. They insure deposits up to $250,000 per depositor, per ownership category. Okay, well, what does that mean? Well, that means that one, if you're an individual and you have two checking accounts, you are only covered up to $250,000 total. Okay, if you're a business and you have two checking accounts, you're covered up to $250,000 total because you are a depositor, even if you have multiple accounts. What it does, the FDIC maintains the Deposit Insurance Fund, or the DIF. Gotta love the government and their abbreviations. So it insures deposits and protects depositors of FDIC insured banks. They have an insurance policy, and it's backed by the full. And also, if a bank does fail, it does happen from time to time, but not very often. They also help fund the resolution activities. So there's a lot of things that have to go into things when a bank fails. Usually what happens is if a bank is failing, they'll try to sell it. This is one of the reasons that Chase has gotten so big is Jamie Dimon, who's the head of Chase, is very, very good at seeing when a bank is about to fail, swooping in and getting all of their deposit accounts for pennies on the dollar. So they come in and they say, Okay. It looks like your balance sheet does not match what you need to be. We're gonna come in, we're gonna rescue you. We get all of your deposit accounts and you are now welcome to the Chase family. And when that happens, FDIC doesn't have to do anything because now it's Chase's problem. You know, we saw this back in 07, 08 when Washington Mutual went under. It was taken over by Chase. The Washington Mutual branch by my house is now a Chase branch. And so now all of those deposits are the property of Chase, and Chase is responsible for taking care of those depositors. Nothing the federal government needs to do. On the other hand, if they can't get a buyer for the bank and it actually just goes under, hasn't happened in a long time. Even Silicon Valley, I believe they got a buyer for that one. First Republic just went under, but really they were bought out. So that's typically what happens when a bank fails. It gets bought out. But in the event that it does not, and now they have angry depositors because nobody likes having their money messed with, they then, FDIC insurance kicks in. Depositors don't have to do a thing. Not a thing. This is what happens. FDIC is backed by the full faith and credit of the United States government. It insures deposits and protects depositors of FDIC insured banks. Again, if you're with a credit union, anytime I say FDIC, you can substitute NCUA. So they have these banks pay an insurance premium. Okay, that makes sense. And they also take those insurance premiums, they invest it, and the return on that investment also goes into the bucket for paying out the depositors. They usually buy, well, they buy treasury notes. So the FDIC funds this with treasury notes, and the interest on the notes also helps to pay for any outflow of resources that needs to happen because of a bank failure. So FDIC insures specific types of bank accounts, checking accounts, savings accounts, money market accounts, cashier's checks, other official items. Remember, if you get a cashier's check, it's already been taken out of your account. It's been taken out of your account, moved to the bank's account. The bank has to worry about that. It's considered cash. It also it insures what's called negotiable order of withdrawal accounts, which I've never heard of, which is interesting, and time deposits, such as certificates of deposit. It does not cover stock investments. It does not cover mutual funds. It doesn't cover bonds. It does not cover annuities or life insurance, safe deposit boxes or their contents, treasury bills, municipal securities, or crypto. So, but it does cover your checking and savings and money market, and that's usually what people are worried about when a bank goes under. Most people who are investors understand that investment accounts, securities, stocks, crypto, none of that's covered. Most people understand the risks with that if they're going to go ahead and invest. So then they cover up to $250,000 per depositor for each account ownership activity. So ownership categories are single accounts, joint accounts. So in other words, if I have an account by myself, I'm covered up to $250,000. If I have an account with my husband, that account, because it's now in a separate ownership category, it's now a joint account, that's covered up to $250,000. IRAs are covered up to $250,000. Specific ones, not all of them. Trust accounts, employee benefit plan accounts, business accounts. The website calls them corporation, partnership, unincorporated association accounts. What that means is business accounts. So if you have a business and you have set it up as an S Corp, you go in and you take in you usually have to show them your articles of organization or incorporation and your EIN number, and you have to show that it was registered with the state. They'll go ahead and open a business account for you. These accounts are now, it's a separate depositor. Okay, so my business account for my business is separate from my personal account for me personally. It's a different ownership category. And it doesn't matter, in my case, my business is a single owner LLC. I am the sole owner of it. And it is not incorporated. Unless, of course, I decide, yes, I want to become an S corp. Then that moves me into a corporation category. Or I could decide to completely dissolve my business and create it as a corporation. And that puts it in a different category. So when they talk about corporation, partnership, or unincorporated, what they mean is corporation, partnership, sole proprietorships, which is what a single owner or LLC is. They also cover government accounts. So all of your deposits in the same ownership category are added together. So I have a business account. My business has a savings account. The two accounts together are considered one ownership category because they're business accounts. I'm insured on those accounts up to $250,000. My personal account is a different ownership category. That one is separately insured up to $250,000. Okay, now, say I have a joint account with my husband. It's a separate ownership category. That one is insured $250,000, even though they may all be at the same institution. Okay. And I have accounts with my kids. Here's where it starts to get tricky. I have accounts where I'm actually on the account with my kids. My kids are adults. I don't know why they haven't closed these accounts and opened new ones, but that's okay. I am not the nosy mom type. I just put money in it if they need it. And I really don't look at their accounts other than to see, are they overdrawn? Do I need to help them out? That's really all I look at their accounts for, although I have full view access to them. I would only be covered up to $250,000 per each account, because one is me and my daughter, she's covered. One is me and my son, he's covered. Okay, so each of those accounts is now covered up to $250,000 because they have different owners. Okay, here's where it can get really challenging. Okay, so if you have a single ownership account, you have your personal account, you have a joint account. Each of those is insured up to $250,000 because they're separate ownership categories. Now, you are insured separately for your ownership interest up to $250,000 for all joint accounts. So let's say, my husband and I open a joint account, the bank goes under, we have $250,000 in it. Well, but what's going to happen is he will get a check for 125 and I will get a check for 125 because it's considered to be 50-50 ownership. However, let's say there's a third person on it. Let's say I open an account with me and my sisters. To make it complicated, I have 5 sisters, four of whom I'm fairly close to. So I go in and I say, hey, the 5 sisters of us, we want to open an account. We're going to call it Harris Family Girls. And it's at the same bank. That bank goes under. What they're going to do now is they're going to say, okay, Donna has joint partnerships or joint accounts with her husband, $125,000. Now this bank account has $250,000 in it, but there are 5 owners. So they're going to split that 250 grand. They're going to split it 5 ways. So each of us will get $50,000. Then if you have one at a different bank, that one is completely separate. So if you have a single ownership account in one FDIC bank and a single ownership account in a different FDIC bank, you'll be insured for up to $250,000 for your single account deposits at each bank. So if I have one at Chase and I have one at Wells Fargo, they're completely separate. Same thing. Let's say I have money in an IRA, I have money in a joint account, I have money in a single account, they're all at the same bank. Well, I'm going to get coverage for my single account, I'm going to get proportional coverage for my joint account, and I'm going to get separately the IRA. So now I have potentially up to $750,000 that I could get if the bank goes under. The downside to this, however, is what if you have a lot more money than that? Businesses often have a lot more money than $250,000 in their accounts. So at that point, if you are at that point, for individuals, I really believe that if you have $250,000 in an individual account and you understand how the coverage works, it's pretty easy to cover yourself. Okay. But for a business, if you have, a $3 million payroll, it's really hard to make sure that you only have $250,000. So you're now at risk. This is where other insurance can come in, and you should be talking to your insurance agent to make sure that you are covered beyond the $250,000 to the $250,000 limit in the event your bank goes under. Again, and I want to emphasize this now at the end too. I'm not saying any banks are going under. I am not up on that. I have not had time to review the financial news to see, and I certainly haven't had time to review any bank's balance sheets to see what may be happening. This is very much just you should know what this is. It's just like any other insurance. We don't want to think about it until the catastrophe hits you. So it's important to know. It's important to understand what you're covered federally. It's also important for you to understand, what your risks are, what your exposure is. Go talk to an insurance agent. If you have a business, I have a wonderful commercial insurance agency that I refer business to, but I do recommend you get an umbrella policy. And you talk to your insurance agent, make sure that you are covered if your bank goes under. I'm pretty confident of Chase, especially with Jamie Dimon in charge, because I feel like he gets it. And with that, I'm going to go ahead and end this video. This will be published on June 20th. So with that, I'm looking forward to talking more. Again, if you have any topics you'd like me to cover, please drop it in the comments. I do look at those. I'll talk to you soon.